So far in this series of videos on the currency strength indicator, we've really only been looking at a single time frame approach. So a single time frame on the indicator itself and looking at that with a chart alongside. Now in this video, I want to bring in a more advanced view of the indicator, and that's the application of multiple time frames. Using several time frames is a powerful approach whatever your trading methodology. And in a sense, what you're looking for is you are looking for a comparison of market sentiment across time frames. You're looking for that ripple effect. The analogy that I use is one of dropping a pebble in a pond. The ripples from that action move out and away and gradually ripple to the side of the pond. And you can think of this in exactly the same way when using multiple time frames. A change in sentiment or a change in trend will appear first on a fast time frame chart. It will then ripple through to a medium speed chart and ultimately to a slower chart, if that is a true change in trend or a true reversal. And that, in essence, is what you're looking for and applying using a multiple time frame approach to the currency strength indicator. You are trying to assess what that particular currency is doing across the time frames, and the reason for that is very simple, because if you can trade with the risk sentiment across the time frames, then the risk on the trade will be lower. You're trading with the dominant trend, if you like. You're trading with the flow of money. Nothing wrong with trading against the trend, counter trend trading. That's fine. Trading pullbacks, whatever it may be. But if you can trade with the trend across the time frames, then the risk on the trade is going to be lower. You will still get the pullbacks, you will still get the reversals, but if you can trade with the dominant trend across the time frames, the risk on the trade is lower. And that's essentially what this approach is trying to achieve for you. It's giving you a broad view across 3 time frames for each currency. If we start by focusing on the Canadian dollar, which is the purple line. Over on the left-hand side, on the 1 minute chart, you can see the Canadian dollar has moved into oversold, it's flattened, and it's now looking as though it's going to have a rounded bottom and start moving away from that region. If we move to the 5 minute chart, similar price action, the Canadian dollar's been falling, it's now just started to move into the oversold area, and on the 15 minute chart, it's still got a way to go. So clearly the sentiment on the Canadian dollar has been negative, it's been selling, but it now appears to be bottoming out in those time frames. And you can start to see that on the 1, and if that ripples through onto the 5 and ultimately onto the 15, then you will have a change in trend on the Canadian dollar. And if you were going to be trading that trend, let's say off the 5 minute chart, then you would be looking to buy the Canadian dollar against another currency. Now if we move our attention to, let's say, the Japanese yen, which is the lilac pinky line, again starting over on the 1 minute chart, you can see there that the Japanese yen is rising towards overbought. Moving to the middle chart, you can see a similar picture there for the yen. It's not reached it, it's about 3/4 of the way up, but it looks as though it's climbing towards overbought there too. And over on the 15, as you would expect, it's moving out and away from an oversold region and starting to climb higher on the 15-minute chart. So if you were trading the yen at this point, you would be looking for a buy on the yen, with the sentiment really telling you that the Japanese yen is being bought across those time frames for the time being. And that is really what you're doing the whole time. You can take another example here. For the US dollar, for example, the red line, it's deep in oversold on the 1 minute chart. On the 5 minute chart in the middle, it's had a slight reversal there. It's humped, but now it appears to be moving back deeper towards the oversold region, and a similar picture on the 15. And that one, for example, you would be looking, if you were going to trade that at this point, you'd be looking to go short, in other words, sell the US dollar. But equally, you would be keeping an eye on that to see whether the US dollar is actually going to move into the oversold region across those time frames, and then perhaps offer you an opportunity to trade with a buy position. And that's what you're looking for the whole time. You're looking for analyzing the currency in isolation across these time frames to trade with the dominant sentiment. So that's on a 1-5-15 combination. Now let's move to look at a second example with slightly longer time frames, but the principle is exactly the same, and you could apply this to any combination of time frames that you would like. Whether it's here we have 1, 5 or 15, you might go to a 15, a 30, an hour, a 4-hour daily, or a daily, weekly, monthly. It doesn't matter, the approach is identical. So let's look at another example. Okay, and here we are. We've moved out in terms of time frame. On the left we now have a 5-minute, in the middle is our 15-minute, and over on the right is our 30-minute. Exactly the same principles. Let's start with the Japanese yen. Over on the 5-minute chart, you can see that the Japanese yen, that's the pinky lilac line, is climbing. It's climbing towards an overbought position. It hasn't arrived there yet. It's got a little way to go. So there's plenty of opportunity there. What's happening on the 15? Well, the Japanese yen has been oversold. It's now moving away from that region and starting to climb out and higher. And on the 30-minute chart, it's yet to make that move, but it certainly looks as though it's going to follow suit. It's flattened out. It's obviously been selling off for some time. It's bottomed out. It now appears to be climbing. It hasn't yet moved through the little dotted line. Not that that's significant. It's just giving you regions. But that is the sense for the Japanese yen. And if you were going to take a position on the Japanese yen on this group of time frames, then you would certainly be looking at a buying opportunity. If you were trading off the 15-minute chart, you know on the 5-minute chart that the yen is climbing. So in the faster time frame, it certainly looks positive. On the 15-minute chart, it's certainly moved away from that region and looks to be climbing too. And on the 30-minute chart, it hasn't yet made that move, but that's what you expect. The slower time frame chart will always move last. But certainly in terms of where the yen is heading next in this particular group of time frames, it's certainly heading higher. It's a buying opportunity at the moment. So trading the yen, you would be looking to buy and trade with the money flow. Let's look at another example here. Let's look at the blue line, the Australian dollar. Over on the 5-minute chart, it's been flattening in the middle and it now looks to be climbing up towards overbought. On the 15-minute chart, you can see there it was deeply oversold. It's moved higher into the center of the chart. It's had a little bit of probably been in a congestion phase there, the Aussie dollar, but now appears to be climbing higher once again. And certainly on the 30-minute chart, you can see there that it was very heavily oversold. It's now moving away from that region and starting to climb higher. And conversely, you can see the dollar, the red line, the US dollar at the top there over on the 5-minute. It's rolled over and now appears to be moving towards oversold. On the 15-minute, similar sort of thing. It was heavily overbought over on the left of the chart on the 15-minute time frame. It's now looking as though it's going to dive deeper towards oversold. And a similar picture on the 30. It was heavily overbought up near the top of the indicator there. It's moving away from that region and now looking to dive deeper. And that, in a sense, is exactly how to use this approach. It's a multi-time frame approach applied to the currency strength indicator. No charts in sight at the moment. You're just looking for the sentiment on the currencies across the time frames as shown to you by the indicator itself. And then it's a case of moving off to the charts and assessing the price action and whatever other indicators you apply and your overall methodology. But you can use this technique in whatever time frame. It doesn't matter if you're a scalping trader or a trend trader or a swing trader. The approach is exactly the same. I hope you found that useful. Please do watch the next video in the series where we'll introduce further techniques for using the currency strength indicator. So thanks for watching and see you again soon, and bye for now.